Welcome to Alpha Strike. Guys, there are two structures in the market. One is the retailer's market structure, and the other is the advanced market structure. The retailer's market structure, which you are taught from the beginning, states that the market goes up by making higher highs and higher lows. If it bounces, then the trend continues. If it squares, then the trend shifts. However, this never happens consistently in the market. You can never make a profit by following this structure in the long run. Why can't it happen? Because the market never moves so simply that it makes a higher high, then a higher low, and then another high. So, let's start the video on advanced market structure. First, long-term highs and long-term lows, which we call long-term swings. Second, intermediate-term highs and intermediate-term lows, which we call intermediate-term swings. And thirdly, short-term highs and short-term lows, which we call short-term swings. The most important among all these is the intermediate-term swings. First of all, let us look at the long-term swings. Long-term swings. We had a market here. There was a PD array, PDRA, on a high time frame, some order block, breaker block, mitigation block, or any rejection block. The market caught the sellers from this PD area. The market shifted its real market structure, meaning the market executed a real choke and shifted to a downtrend. This high, which reacted to the high time frame PD array and shifted the real market structure, will stay with us. If you reverse all these scenarios, we will get a long-term low. I hope you have understood it. The long-term high gives us a narrative in the market about what the market is going to do now and what the market is saying. The market has reversed from a high time frame PD array. The market structure has shifted, meaning that now the market has moved from an uptrend to a downtrend. If I say compression, then the smart money is reversing, and then we get intermediate-term swings, one of the most important swings in the market structure. We have two types of intermediate-term swings. The first type is classic intermediate-term swings. The second type is rebalanced intermediate-term swings. Let's first look at the classic intermediate-term swings. This was the market. The market made a swing here, made a swing here, and made a swing high here. Now we have three swing highs. This was the market. The market made a swing here, made a swing here, and made a swing high here. Now we have three swing highs. So, what is an intermediate-term high? It's the swing high that has a swing high on its left side and a swing high on its right side. This will be our intermediate-term high. The two smaller swing highs on either side, we will short them. Term swings are called highs, but we will study short-term swings further to understand their function in the market. We had classic intermediate swings. These are not so important. We have a more important type, rebalanced intermediate swings. Let's see what these are. We had this market. Here, we had a fair value gap. I hope you know what fair value gaps are. In this playlist, I will also make a video on the next fair value gap. If someone asks you, what is the most important thing in the market? What will you say? The most important things in the market are two: liquidity and fair value gaps. You may not understand this right now, but you will understand it after 1 year, 2 years, or 5 years. Yes, the market runs on just two things: liquidity and balance. For the rebalance, there was a fair value gap here. The market made a swing high, reversed, tapped into this fair value gap, and then continued. The swing high that reacts in the market by tapping into the fair value gap becomes our intermediate-term high. So now we have two types. One is the classic intermediate-term high, which has swing highs on its left and right. The second is the high that taps into the fair value gap. The intermediate-term swings give us a framework for the market. What is the market going to do? This is what has happened. This setup is being formed. Now you have to take an entry like this. Let us provide a complete framework. Now short-term swings. We had the market. Where is the liquidity lying in the market? This is a high. Liquidity is lying above it. This is a low. Liquidity is lying below it. Those swing highs and swing lows, above and below which the liquidity lies, are short-term highs and short-term lows. Okay, if you don't know below which highs and lows the liquidity lies, what liquidity is, how liquidity works, how the market runs on liquidity, how a run on liquidity happens, how liquidity is drawn, how a liquidity sweep happens, or what the types of liquidity are, I have made an advanced video on all these things. You will find the link in the option above. You can see it by tapping on it. There are also short-term swings that I mentioned in the first video, those swings that come from intermediate swings, the ones on the right and left, which are also short-term swings. Long-term swings have told you the narrative, intermediate-term swings have given you the framework, and short-term swings will give you a trigger. Guys, our market was in an uptrend. There was a 4-hour breakdown block here. I have marked that. We will wait for the market to reach there. Here, you should notice one thing. Our breakdown block is above, but the market is already falling. The market is creating an inducement here. This high has not been overtaken by this high. You should also notice that no highs are violating each other here, meaning liquidation is being engineered. Sellers are being told, we are going to sell. We should sell quickly. By luring all the sellers here, the market will go up and their stop losses will be hit. Look here. What happened? The market fell with displacement, then fell with a surge. It broke this low and broke this low. All the retailers felt that the market structure had shifted and the market got shocked. Now, the downtrend isn't going to start in the market, and this low added more confirmation. Now, all the sellers are sitting there after selling. The market will eat their stop losses and hit our PD array. The market hit our PD array with all the sellers' positions. Now we will wait for the market to break this. This is our real choke. The market has choked us here. Now there will be a real smart money reversal because this is a true choke. After eating the liquidity of the inducement, we have to break the intermediate choke. You will see this swing low. It's an intermediate swing low. So this broke and the market got shocked. We will wait for another intermediate term high to form in the market. When will the intermediate term high form? It will form when the market enters the fair value gap. We had a fair value gap. You can see that we had a fair value gap. The market came into it. The intermediate term high has arrived. Still, we won't take an entry yet. We will take a direct entry here after the formation of a short-term high and after its liquidity sweep. This is what we have. We have formed a short-term high. What did we have? An intermediate-term high and a short-term high. Here we will also note, this was our long-term high. Why? Because it hit the PD array. The market structure of the high time frame shifted, and it gave us a narrative. Now, the market will sell. After that, this was our intermediate term high. But the real market structure is that it waited for this high to break. That high was broken. Banks entered there, and the market fell from there. If you like the video, subscribe to channel. Thanks for watching.